My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people, my friends, just trying to make you some money. My job is not just entertainment, to educate, teach. So call me 1-800-743-CNBC or tweet me at Jim Cramer. No reason to worry about profit taking as long as the money stays in the market. And that's exactly what happened today as traders rang the register on big tech all morning and then swapped into the lagging banks, oils, drugs, industrials. No reason to worry about profit taking as long as the money stays put. And that's how the Dow gained 153 points. S&P advanced 0.51%, and the Nasdaq dipped 0.16%. That was a nice comeback from the bottom. It's a very encouraging day and week for the averages. Now, it was an odd mix of winners, given that interest rates continued their inexorable rise. This is not the kind of environment where traders would typically buy the industrials or the drug stocks. But I think we had this kind of move precisely because traders are afraid. They're afraid of not being in stocks right now. And that is a very nice change from the nauseating selling pressure we've gotten quite used to since the Fed declared war on inflation back in November, and so many stocks are in tatters, down 40, 50, 60, 70, 80% from their highs. The market's rally seems a little surreal, though, given what's happening in Ukraine. I'm not exactly comfortable with the idea of a cornered Putin ready to spring tactical nuclear weapons on the Ukrainians, something our intelligence agencies keep hinting at. Then again, as the day went on, Russia started making noises about scaling back its ambitions and only focusing on the eastern part of Ukraine, where they've been backing separatist militias for years. If Putin's really given up on Kyiv, that is a good thing. I mean, who knows how high this market would go if Putin declared victory in return for a neutrality pact and a pledge for Ukraine to be part of some new kind of Kyiv-Warsaw pact. Remember the Warsaw Pact of old? Let me give you another view, too. Just like in 1990 when Iraq invaded Kuwait, there were money managers who remained forever hopeful that Saddam would pull out and we wouldn't have a war. It turned out to be a crazy assumption back then. I think it's equally crazy to assume that Putin will just throw in the towel. That's not his style. Then again, it increasingly looks like Russia simply can't beat Ukraine in a conventional way, at least not in a way that matters, like they did with the Chechens and Grozny, meaning they can't have total colonial subjugation. Too many people, too many buildings, too much of powerful allies. So now traders are terrified that they won't have enough stock in the unlikely event that peace breaks out over the weekend. In other words, they cover their shorts. This is what happened endlessly in 1990. With that in mind, what's in the game plan for next week? All right, there's not much in the way of earnings on Monday, but I'm hoping to get a read on the flagging retail sector. And boy, as you heard from Melissa's show before me, it's awful. And we got Dave and Buster's. They're part of the close. They're both restaurant stocks and retailers, and those two have become pariahs in this market. Some people seem to think that high inflation is destroying these two cohorts. I don't know. Hey, maybe Dave and Buster's tell us. They have a very smart management. Let's see what they have to say. Tuesday's packed with companies that could rock and roll the market. In the morning, we get results from McCormick, the spice company, and I think this inventive company will deliver an excellent number and surprise once again. We keep hearing that the hybrid workforce is here to stay. Well, you know what that means? It means people continue to cook at home. McCormick's been as dependable as they come since the pandemic got rolling, and I bet this time will be no different. After the close, we hear from two companies that stand at the crossroads of this market, and they're Micron and Lululemon. Micron, the commodity chip maker, has seen its stock plunge from 98 in January to 78 today. I think it can tell a good story, a story about demand coupled with not enough new supply to upset the apple cart of pricing. To me, Micron, not Intel, is the real hero of American semiconductor manufacturing. So if you're looking for a play on domestic chip production, have at it. It's going to be Micron. You got my blessing to buy. As for Lulu, well, apparel has been in the crosshairs of the sellers, even as most of these companies are holding up pretty well. Lulu is a best-of-breed operator, yet sellers keep surfacing every time the stock lifts. Maybe they can stem the selling with this conference call. It's been its own private bear market. I want to know how Mirror is doing. That's their smart home gym device that my daughter loves so much. Also, after the close, speaking of bear markets, we got results from PVH. That's the parent of Calvin Klein and Tommy Hilfiger, which is being clobbered by the soaring price of cotton. Every commodity seems scarce these days, especially the ones that go into apparel. I'm not looking for a big quarter here, but nobody else is either. So PVH stock hasn't done much in ages. Maybe something happens positive. Hey, speaking of stories that could be positive that haven't worked out, RH, which is just delivered. That's the retailer formerly known as Restoration Hardware. This is an experiential, high-end chain with gorgeous stuff that's doing amazing things to entertain and entice its customers into its mansions, palace, whatever you want to call them. RH has a habit of crushing the numbers, sending its stock into the stratosphere that very evening, only to see it drift down steadily, drip by drip by drip, until the next quarter, when the same thing happens again. Well, here we are. And I'm betting the story repeats itself. This is not just some furniture chain. It's a series of destinations where you buy incredible stuff. Somehow Wall Street doesn't understand that. Maybe one day they will. Maybe you have to buy it with deep in the money calls. Wednesday morning, we find out how America's small business paymaster is doing when we hear about from Paychex. In truth, that's no longer actually the full story. Paychex has become a partner handling many human resources needs for small and medium-sized enterprises. This company has a history of delivering beat-and-raise quarters with this red-hot labor market. I doubt they can disappoint. At the same time, we get results from Five Below. That's the $5 store, and lots of analysts have been praising this one lately. I suspect that means they're going to have good numbers because Wall Street hasn't been too enthusiastic about retail in general. Now, this is still a great concept. Kids love it. Families safe, even as, sadly, much of the merchandise, I believe, is going to be destined for the landfill. Thursday morning, Walgreens Boots Alliance reports, and I'm hoping for some improvement here because the performance gap between Walgreens and its main competitor, CVS, has gotten absurd. Which one, it's flipped which one was in the Dow. That's right. In the old days, CVS and Walgreens were a pair of so-so operators. But then CVS bought Aetna, Larry Merlot's smart idea, and became much more of a healthcare destination, a decision that suddenly looked very smart once COVID came along, and they won lots of long-term business. What's Walgreens going to do to challenge them? I don't know. Let's find out. Finally, on Friday, big, the Labor Department's non-farm payroll report comes out, and I fear that it will show the tightest labor market in 50 years. Now, I know that means jobs are plentiful, but talent isn't, which means wage inflation leading to a price inflation into an endless spiral. Now, many of you might think that full employment is a high-quality problem, but the Federal Reserve has to balance job growth with price stability. They've done an amazing job making sure people can get hired, but now their goal is to stamp out inflation, plain and simple, which means a strong employment number will give the Fed cover to slam the brakes on the economy even harder than they seem to want to. So if you're a bull, you have to hope that we get a disappointing labor report, or perhaps you think that this is the last too strong one, and you want to buy off of that. If Fed Chief Jay Powell doesn't catch a break soon when it comes to inflation, then it's 50 basis point rate hikes for as far as the eye can see. I think that goes against Powell's instincts, but at this point, long-term interest rates have gotten so high versus where they were a year ago that I think the bond markets are already pricing in some very aggressive short-term rate hikes from the Fed. But the bottom line, even if we get lots of inflationary data next week, I think it's already being reflected in the stock market as we come to accept the fact that the Federal Reserve is on a mission to kill inflation now, something that the market is deciding might be better for stocks than we ever thought possible, even 1 month ago. Let's go to Max in Illinois, please. Max.
Hey, what's up, Jim?
Not much. How about you, Max? What's going on? Looking for the weekend. What's happening?
Yeah, me too. Happy Friday. Hey, interested in a stock that had a huge run-up in 2021. It's been backtracking since September. They had record Q4 earnings. They beat estimates for a fourth time in a row, and their future forecast is above expectations. Quality franchise and terrific CEO were your words before. What do you think of Dick's Sporting Goods ahead of the summer?
Okay, I've been talking again about these companies that sell things, profitable, returns money to shareholders. And Dick's is what I'm talking about. This sells at 8 times earnings. That's part of the bear market. The bear market since November. High-quality retailers selling at 8 times earnings, that just makes no sense to me. I totally agree with you. I think it's a buy. Let's go to Stephen in California, please. Stephen.
Hey, Jim, a huge fan from Sacramento.
Oh, man, the old days. 10th and P, what's happening?
Hey, my question for you is, given today's current market, would a debt-free growth company like Palantir be able to outpace the S&P given its ties to cybersecurity and supply chains for businesses?
Well, I think it's possible, but I'm not recommending stocks that aren't making money right now. There's so many in that. I mean, I could tell you buy Palo Alto. I'd much rather have you do that. I have to admit, I've been hard line on this. The companies that are losing money are not going to have a friend with Jim Cramer and Mad Money. Let's go to Michelle in New Hampshire. Michelle.
Hi, Jim. Great to meet you.
Oh, same, Michelle. Thank you so much for calling.
First, I want to say thank you. My husband gave me your book, Get Rich Carefully, a few birthdays ago.
Thank you.
I know, right? It's not that romantic, but it was a great gift. Taught me a ton, helped me grow well. So thanks for helping.
It's not Anna Karenina, but, you know, it'll have to do. Thank you. Thank you.
here's my dilemma. I am staring down the barrel of a 25% loss in the value of my position in Clorox. I can wait for it to recover, or I could cut bait and put that money to work elsewhere. My question for you, Jim, is CLX. Should I hold or sell?
This is so hard. Clorox is not doing well. So many of their different divisions aren't doing well. If they don't have a good grilling season, it's going to be tough. They've got a good balance sheet. It only yields 3.5 when rates are going higher. I'm going to have to say that I think it's 50-50 on this. This is a push, and I feel badly about that. I think that Linda Rendell's doing very good. I don't like her portfolio. Plain and simple, I don't like it. Now, even when we get inflationary data next week, I think it's already reflected in the stock market. Unless the market has a huge run into Friday, that would be disappointing. We don't want to see that. Mad Money tonight, D-Local's on a mission to bring payment processing to emerging countries. The company's from Uruguay, and I'm learning more about the company's prospects with the CEO. Again, a stock that's down huge from the high. Then there's a new utility investment out there, so I'm taking a look at Constellation Energy Group to see if this nuclear power, largely power producer, could help power your portfolio. A lot of powers there. And diversification is one of the most important investing lessons I know. Gary Gensler, my friend from the SEC, always taught me that. So, am I diversified? We're going to play it tonight, see if your portfolio passes the test. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.